The primary purpose of this podcast is to educate and inform. The views, information, or opinions expressed by hosts or guests are their own. Neither the show nor any of its content should be construed as investment advice or as a recommendation to buy or sell any particular security. Security-specific information shared on this podcast should not be relied upon as a basis for your own investment decisions. Be sure to do your own research. The podcast hosts and participants may have a position in the securities mentioned personally through sub-accounts and or through separate funds and may change their holdings at any time.
Welcome to This Week in Intelligent Investing, where we examine timely and timeless investing topics to help you become a better investor. Enjoy authentic, unscripted discussion featuring Phil Ordway, Elliot Turner, and other thought-leading investors, brought to you by MOI Global. And now, here's your host, John Mihaljevic.
Welcome, everybody, to This Week in Intelligent Investing. Great to have you with us. Great to have my co-hosts as well, Elliot Turner and Phil Ordway. We have a great show ahead. Let's get started. Phil, over to you.
Thanks, John. So I'm sure you and most people probably saw the big news this week that GE is going to be breaking up into three pieces over the next couple of years. So I wanted to take that chance to talk about this idea of a conglomerate and what it means and why I think it's so patently ridiculous that people are talking about this as some sort of big deal and signifying the end of conglomerates, because I think it just misses the entire point and it's a really stupid idea. And I think there's a lot of actually really good conglomerates still out there. And I think it's a really interesting area to focus on. But as by way of background, in case anybody hasn't seen the news, isn't familiar with the backstory here, GE's been a complete and utter disaster for a couple of decades now, and it's all just come to light, really. I mean, unless you weren't really paying attention in the last, call it 3 to 4 years. So they announced as kind of a final step in the cleanup and the turnaround process that they're going to split into three pieces. So they're going to spin off their healthcare business in early 2023, and then they're going to spin off the recombined energy and power segment in early 2024. And the company that is remaining is going to be focused primarily in the aviation, the jet engine business. And that'll be the company that stays behind, with Larry Culp continuing to run that. But all the other two segments will have their own boards and their own standalone corporate structures. But to get to this point, you really have to go back at least 20 years when Jack Welch was still running the company. And almost exactly 20 years ago, in the summer of 2000, GE was actually the world's most valuable company. So I was thinking about the episode we did, I don't remember how many ago it was. It was back in the first season, months ago now, about the staying power of the top 5 and 10, top 20 companies in the world by market cap. And we talked about GE as kind of the poster child for things that couldn't go wrong. And sure enough, it was stunning. I mean, GE was the definition of a blue chip for many, many decades. And going up into the dot-com bust in 2000, it was literally the world's most valuable company. It had about a $600 billion market cap with a AAA credit rating in the second and third quarter of 2000. Today, it has a $120 billion market cap, which is about the same as a recent IPO. We're recording this on November 11th of 2021. GE's entire market cap today is about the same of Rivian's market cap. Just went public this week, a company that has no revenue, almost literally zero revenue. So to tell you how far GE has fallen and where things kind of stand in today's markets, that gives you a pretty good idea. But if you were to run the numbers, GE is down about 76%. It's a negative 4% a year from its peak in 2000 through today. The S&P 500 over that period has done a positive 7.4% a year. So if you'd invested $100 in GE back then, you'd have about $42 today with dividends reinvested in security versus about $458 if you'd invested in the S&P 500 dividends reinvested there. So a literally 10x difference in that simple decision you would have faced back then, hypothetically. It's just kind of staggering. But really what undid GE, and this is, I think, what a lot of people seem to not be focusing on, was just decades of horrendous capital allocation and mismanagement. I mean, it's still so odd to me that people had this halo effect around Jack Welch and what he did at GE and all the executives that came out of GE, when it was pretty patently obvious to anybody paying attention that the company was actually very poorly managed and that he built up this super leveraged, private equity hedge fund Frankenstein called GE Capital that he literally referred to as the blob. It wasn't some sort of like hidden hush hush kind of Enron thing. This was all out in the open right there for anybody to see. And it was literally just the company's internal cookie jar, so that every time one company within GE's empire had a bad quarter or a bad month, they just take money out of GE Capital to kind of fluff the results and make it look better for everybody. And that's really the undoing of the whole company. So it's just kind of mind-boggling to me that this has been cast as the end of conglomerates when it really has nothing to do with it. But here are some of the sound bites that I pulled from this week. An end of an era and the end of the conglomerate. In this digital economy, you have to be agile and you have to be able to move quickly. You can't be burdened down in a 3-pontoon boat. That was a very prominent sell side note. Then there was a note from a business school professor who apparently makes a full-time job out of studying GE and said, GE is telling us based on the market's advice that smaller is better. And the rise of the rise of private equity has made M&A too competitive for GE or any other conglomerates. I think all three of those are just completely and totally dead wrong. As for the digital economy, you need to move fast kind of thing. It has nothing to do with the digital economy. If you want to look for evidence of the feasibility, the viability, or the intelligence of pursuing a conglomerate strategy, look no further than what happened about 2 weeks ago when Facebook rebranded itself Metaverse. I mean, Facebook has now become a conglomerate in its own right. And if you didn't think of that in that way, I mean, look at Alphabet, right? I mean, that was 5 or 6 years ago now, very much a conglomerate strategy. Amazon, very much a conglomerate strategy. Would this same sell-side analyst be talking about not being able to move quickly enough because you have a 3-pontoon boat? I would say Amazon's almost by definition a 3-pontoon boat. It seems to work pretty well for them. So this really doesn't have anything to do with that. I also find it very odd that in this whole discussion about what's a conglomerate, what's not, this is the end of the conglomerate era or whatever, none of those articles seem to mention any other companies but for some of the usual, like Honeywell, 3M. Occasionally they'd throw in Roper, which, by the way, has been enormously successful and very intelligently run. Of course, nobody mentioned Berkshire in any of these articles, which is, beyond bizarre, but, goes without saying. But look around the world. I mean, SoftBank is a conglomerate, right? I mean, that has not worked well for them, but it has nothing to do with the conglomerate structure. It has everything to do with the investment decisions they've made and the capital allocation strategies they've pursued. Toshiba, one of the biggest industrial conglomerates in Asia, is actually getting pressure from activists to split up right now. United Technologies, DuPont, Siemens, they've all kind of had that moment. To a lesser extent, IBM has had that moment. But again, this has nothing to do with the conglomerate structure. It has everything to do with the individual companies' performance. And if you look back at GE specifically, I mean, again, the great mistake here was 20 or 30 years of financial mismanagement. And then when GE Capital was laid bare as an over-leveraged private hedge fund, private equity vehicle internally, it took them more than a decade to unwind GE Capital. And along the way, what did they do? They made another huge, horrible conglomerate-style acquisition when they bought Alstom in 2015. That required a $23 billion write-off less than 3 years after it was acquired. So if you look at the amount of money that they've lit on fire, it's absolutely no surprise that the market cap's down 76% in the last 20 plus years. Right? I mean, that's just mismanagement. It could have happened if this was a single strategy or a multi-strategy, a conglomerate, whatever. It has nothing to do with it. Conglomerates are just businesses. There is no magic here. And so I made a list of the key features of a successful conglomerate and an unsuccessful conglomerate. And it's literally just like business 101, two sides of the same coin kind of thing, right? A successful conglomerate will have good capital allocation. An unsuccessful conglomerate will have a misallocation of capital. They'll pursue growth for its own sake. They'll chase all these different things instead of doing, the sane, rational, long-term thing with their capital. Most good conglomerates have a decentralized structure without a lot of corporate bureaucracy and bloat. I think GE is notorious for its corporate bureaucracy and bloat, right? I mean, one of the things that I'll never forget was how when Jeff Immelt was basically forced out in favor of Larry Culp when Larry Culp took the job, when Jeff Immelt was forced out, was that it came out that Jeff Immelt was traveling with not one, but two of the high-end G7, whatever the biggest corporate jet he could find was, that one would fly around behind him around the world just in case the first one had any sort of delay or mechanical problem or malfunction. I mean, think about that. It's insane. A good conglomerate will have tax efficiency at its core and the capital allocation function. An unsuccessful conglomerate will just continuously kind of shuffle and play gin rummy with its assets, irrespective of the long-term most efficient thing to do. In this case, GE seemed to really pursue the wrong kind of shareholders. A successful conglomerate will go out of its way to try to attract quality shareholders and try to go after strong, like-minded owners of the business. Whereas a lot of times you see conglomerates do things like, oh, well, we're going after the broadest base investor. We're going to pay a good dividend. I mean, GE was touting its dividend and paying a dividend it couldn't afford for at least a decade until it all finally came down, right? I mean, it was literally a house of cards when it came to the dividend. There's no chance of them being able to afford that. A good conglomerate is going to act like a long-term owner of a business. They're going to act like you would hope if this was their sole asset, there's a real stewardship there. I mean, John brought it up a week or two ago. The other side of the coin is you get into some sort of sclerotic co-ownership situation like the Keiretsus occasionally become in Japan, or the Chaebols become in Korea, where it's really just kind of like a good old boy network almost, where I'm going to own a little bit of this, a little bit of that, and we're all just going to pretend like returns don't matter. I mean, it's nonsense, right? I mean, a good conglomerate is about pursuing efficiency and allowing the most seamless transactions and transfers of value to occur, whereas bad conglomerates really just become completely tolerant of inefficiency, right? They almost breed inefficiency. And I think more than anything, I mean, where conglomerates do occasionally get some valid criticisms is where they lack transparency and they lack good accounting. But again, the good conglomerates all are completely transparent, all have very good reporting, all have crystal clear accounting. And GE was the poster child of the opposite, right? I mean, they literally made financial shenanigans into an art form there internally. And I think that's often true of other conglomerates that get into trouble. This isn't rocket science. I don't understand why you would paint all companies with a broad brush and say that the era of the conglomerate is over. I mean, it's not just in the US. I mean, look around at Fosun or Tata Group or L&T in India or Exor in Europe or Reliance Industries, LG. I just made a list. Certainly where Larry Culp came from here in the U.S. and Danaher has been just an unbelievable success story. Does anybody believe the era of the conglomerate's over just because Danaher kind of outgrew its size and split into a couple of parts? I mean, when it works, it really works. I think that's the key distinction for me and why it gets so much attention is when a conglomerate's successful, it's really successful. When it's not successful, it ends spectacularly. But I just view that as kind of a natural outcome of any business, right? I mean, the long-term survival rate for any business isn't all that high. And so when you add ego and leverage and you allow people to start fighting internally over their own little fiefdoms, and it becomes less about serving the customer and running the business well and more about preserving this, sclerotic corporate body, that's when you really get into trouble. So I also think it's ironic today, and there's lessons, I think, in history from this. The last time there was a legitimate conglomerate boom was actually the 1960s. And there's some fascinating stuff to be read. We'll try to link to it in the show notes. I went back through it this morning just to kind of refresh on it. I mean, on the bad side of the ledger, you had a company like LTV run by this guy Ling, who was, kind of a I don't know who I'd compare him to in the current era. It probably wouldn't be fair to either side, but he ran around just buying everything he possibly could like a drunken sailor, and the whole thing blew up spectacularly in his face. The stock went from a peak of $169 a share in the 1967 top for in its Nifty 50 heyday down to $4.25 just 3 years later. He was ousted. The company actually limped along for a few more decades and finally liquidated. On the other side of the spectrum, you have Teledyne. Right? I mean, Henry Singleton's one of the single brightest business leaders we've ever had, one of the great conglomerate operators we've ever had. And so I don't understand why you'd ever paint everyone with the same brush. And so I do think it's funny, though, that, back then what fueled this whole boom was likewise kind of this mania, this popularity that seems to come and go. And it has a lot of, commonalities with today, except today it's being expressed in other areas, right? Private equity, SPACs, other things seem to be viewed as better than they are, whereas conglomerates are apparently viewed as worse than they really are. So that's really, I was up on a soapbox with a lot of this, but I just think I think the GE is a fascinating example. I haven't read the book Lights Out yet, but I'm planning to read it hopefully this year over the holidays. And I think there's just so many fascinating lessons to be learned from GE. just like there are fascinating lessons to be learned from Sears and plenty of others that have, had these amazing multi-decade runs and then failed. But saying this has anything to do with the conglomerate structure is just totally and completely wrong. And I think it paints these other companies in a poor light. And so I'll end it there and ask you guys what you think about GE and the conglomerate structure and what some of your favorite conglomerates are that are still out there.
Yeah, so I mean, I have my own theory on why GE suffered as they have in recent years. And if you look at the month they declared they're leaving Stanford and moving to Boston, that was the post-GFC high. And they're down 55% since then. And, it's quite remarkable how they spent that entire year planning this move. And then the next year, their entire business, the rug was pulled out from under them. It's like, who the hell cares where you're headquartered? And they said it was about attracting better talent. Well, when your company collapses 70% from there, it's not going to make a difference where you're headquartered in terms of attracting talent. Like, what a colossal distraction. And then you look at Charter, like a year later, Charter announced they'd build their permanent home in Stanford, and that stock's more than doubled since then. So I blame it all on leaving Stanford. That's what did them in. Maybe, home bias, whatever. But in all seriousness, I think there is some truth to the fact that they were focused on all the wrong things, and they were thinking about all the wrong things. That acquisition of Alstom, when you were talking about, like, when you mentioned that phrase about M&A being too competitive, like, no one forced them to go into a bidding war against Siemens, where it actually made sense to have the asset, to go into a bidding war and then not even integrate it well. Like, that was a choice. Why'd they do it? Who the hell knows? It's hard to know now, but you could complain about M&A being too competitive, but you kind of make your own bed when you do such things. And this whole idea that the era of the conglomerate is over. I think that's a headline that should have been written in the 70s or 80s. I hardly feel like we've had a conglomerate era. If anything, spinoffs have been far more the rage. Deagglomeration has been far more prominent for at least a couple decades than has been conglomeration. So I know maybe the phrase can mean whatever you want it to mean. And I think to the extent that you pointed out some really good examples today with companies like Facebook, Meta and Alphabet, those are absolutely conglomerates by most standards. I think when you invoke Singleton, I think that's spot on. But the beauty of it was that he was like, he was both a conglomerator and a deglomerator, if that's a word. And so that gets me to my favorite conglomerate. It's IAC. They're builders, but they're not builders to own things forever. They're builders to then give things their own wings and set them free and then restart the process again. So I think it's a pretty beautiful model, and I think it's really interesting.
Yeah, that's a great point, by the way, too, about how they actually were writing a lot about the end of the conglomerates in the 1980s, because to your point, a lot of those conglomerates from the 60s didn't last. And so by the 80s, it had gone on to something new and shinier. And so it was the end of the conglomerates. And think about how dumb it would have been to say in 1985, like, boy, the era of the conglomerate's over. I'm not going to look at this Berkshire Hathaway thing. Like, nothing could be dumber, right? And like the same thing is true today. You're right. I mean, IAC is a conglomerate. We were getting to this, by the way, a little bit last week. We were talking about the internal investment function that I think a lot of companies should consider starting, because it just makes so much sense. And a lot of people took that to mean a conglomerate. And then they very correctly brought up this notion of the conglomerate discount. And look, that's true. There's plenty of empirical evidence that conglomerates are going to trade at a 10, 12, 15% discount to their net asset value, to the so-called sum of the parts. And that's fine. But again, my response to that would be, who cares? If you have a good operator, a good corporate governance system, a good structure in place, and a good business or multiple businesses under one umbrella, and it trades 10% cheap, I should be excited about that. Why would I care if that gap persists forever if the business itself is making progress and I bought it intelligently, right? I mean, it literally makes absolutely no difference to me. And if I had to pick between having a stock that's 10% undervalued and 10% overvalued, I know which side I'd fall on, right? And so whether it's IEC, which is a great one, or Exor over in Europe, which I think falls under the same category sometimes, I mean, those are intriguing, well-managed businesses, in my opinion. And whether you call them a conglomerate or not is completely irrelevant.
And I think what all the great conglomerates have in common, the ones that we've mentioned here, I had in the past been involved with Exor as well. Berkshire, when you mentioned Singleton as well, the Rails brothers with Danaher, all of these groups were focused both on, growing and shrinking, and had different strategies for each side of things, and recognized the environment when it was time to grow and when it was time to shrink. And, I think when they wrote those first wave of articles about the end of the conglomerate era, the big lesson was that every company had been focused on growing in perpetuity, and you just can't do that. And you think about a company like Valiant, who was, part roll-up. Conglomerate may be wrong because they weren't exactly like in separate verticals, though they did cast a very wide net within one industry. What went wrong is they had to keep growing with the same strategy that they had been growing with. And there was no situational awareness. There was no general asking of oneself, like introspectively, does this environment reward the same things that got me here? And, I think that's one of the most important things every investor should ask themselves. That's part of investing in general, having this lick your finger, stick it up in the air, figure out which way the wind's blowing a little bit and what's, important. It's part of what, we'd talked about with generally understanding yourself as an investor. GE was the opposite, like overpaying for Alstom at exactly the wrong time. I think that's one of the key things that did themselves in. And I'll still blame the headquarters anyway.
Yeah, I'll jump in. I think, Phil, what you mentioned just touches on what we see a lot, which is just simplistic stories being pushed in the media and also by the sell side often. It reminds me a little, saying that this is the end of conglomerates reminds me a little bit of that Francis Fukuyama line, end of history, which we know wasn't quite the end of history. Don't have a ton to say on GE. I think the thing that upsets me the most with regard to the GE story is just how much recognition and awe was sent Jack Welch's way for decades, probably. And he really made a killing for himself also during that period, and has his name on, I think, a bunch of institutions, when actually he should probably go down as one of the worst capital allocators and not one of the best. I think in terms of examples, you guys have touched on some good ones like Berkshire, Exor, obviously, Bolloré, another one in Europe that could be called a conglomerate. There's a smaller company in the US called IDT. Howard Jonas runs that, has done pretty well over a long period of time. They're a little bit like a poor man's IAC, I would say. They also tend to incubate some businesses and spin them off and so forth. What I think is really interesting are kind of more industry-focused conglomerates like, Alphabet, Amazon, maybe Constellation Software can in some ways be viewed as a conglomerate. Or if you want, in terms of kind of luxury consumer brands, LVMH might be considered a conglomerate. Maybe even on the real estate kind of hard asset side, Brookfield. And those are all really well run companies over time. So a few thoughts from me.
Yeah, no, it's a good point. And I think it's where it gets so arbitrary is, Brookfield is definitely a conglomerate when you look at the number of different things it owns, but because it all kind of falls under the realm of quote unquote infrastructure a lot of times, or real estate, they don't seem to get lumped in with 3M or Danaher or whatever. And it's just, my point would be, I guess a conglomerate structure can be like leverage in a sense almost, because it can magnify the good and the bad, right? So in cases like GE, where it's clearly propped up by financial engineering, it almost gives you more runway to hide the decline and the malfeasance, because you're just taking from one pocket and putting it in the other, right? You're stealing from one side and reimbursing the other to just kind of mask the overall decline of the corporate entity, whereas it would be a little bit clearer. I also find it equally ridiculous, by the way, when people say like, oh, well, you shouldn't have a conglomerate strategy because investors prefer clarity and transparency and focus, and we're going to have a disciplined capital allocation strategy, and all these buzzwords that people throw around. I mean, that's nonsense too, right? I mean, some of the best managed, most transparent, most focused companies that I've ever seen are in a conglomerate structure. So it really doesn't have anything to do with that. I mean, saying that investors prefer, quote unquote, pure plays is about as dumb as saying that, investors prefer dividends. Like, no, you should pay a dividend because it's the right decision and it's what the situation calls for. And you should be a quote unquote pure play if that's what makes sense for this business and this industry at this point in time, not because that's what investors prefer. Investors prefer you doing what makes sense for the business and the customers it's serving. And that's really the end of it. It shouldn't be a whole lot more complicated than that. So I am interested, though, and I'll leave it at this. If folks want to chime in with other examples of well-run, I mean, I'm not in the short selling business. The poorly run businesses are good teaching exercises, but I am interested in some of the smaller conglomerates that are out there that have managed to fend off this little bit of pessimism that maybe is out there in the market, because it just seems like there's so much runway ahead of them, and I'm sure I'm missing some good examples. So with that, I'll pass it back over to you, John.
Great. Thank you so much, Phil. Good discussion. Let's go over to Elliot.
All right. I want to talk about the Kasparov Principle, named after, or I don't think he dubbed it himself, but the chess player, the world grandmaster. And what Kasparov phrased the principle as is human plus machine plus superior process is the key. So the idea is that human plus machine beats either human or machine. And this was essentially his main takeaway after the experience of competing against Deep Blue. So as it stands today, humans can no longer beat computers. Like great humans can no longer beat the most powerful computers at chess. It's not even close anymore. But a great human chess player with a fairly modestly powered computer can dominate the best machines, the best computers in the world. So the way Kasparov phrased this is that people bring the strategy, machines bring the tactics. My first exposure to the phrase was my long-term investment in InvestNet, where the company's visionary founder, this gentleman, Judd Bregman, who died tragically a couple of years ago, he would talk about building tools to empower advisors to build their practices, like investment advisors, so that they could build their practices around this principle, that powering advisors with machines to do some of the more commodified parts of the job would let advisors focus on the more important parts that they could do well themselves that required a human touch, especially in an industry where, emotion and dealing with it is something that's pretty important. So the entire idea was born out of Kasparov's battles with Deep Blue. And he talked about Kasparov has since talked about his own evolution, where, when he was in those fights, he actually called himself a skeptic of AI's abilities and its promise down the line, to the point where now he fully embraces the idea that we should find opportunities where humans can work together with machines to create superior outcomes. So he emphasizes the upsides, and there are uniquely brilliant moments for humans where it happens, but it's also not so easy. So what got me thinking a lot about this recently, like I settled on the topic for this week after reading an article in Business Insider about Zillow's exiting of the iBuying business. If you listen to Zillow's call, they gave a lot of blame on their models and how hard it is to build the models, and humans throwing their damn machines under the bus. But in this Business Insider article, they talked about how it was actually not a model mistake at all. It was the fault of this project called Project Ketchup, after Heinz Ketchup, to be a play on the word catch up, the words catch up, where they set the ambition of having as much inventory as Open Door. And so in this Project Ketchup, they decided to make their own models, they being the humans, to make their own models more aggressive to justify paying more for given homes. And so, the literal quote from the article was that employees' account suggested that Zillow's iBuying problems had less to do with a glitch in its computer-driven algorithmic approach to purchasing homes are unpredictable swings in prices, and more to do with the over-exuberance of human managers. And that's one of the areas, Kasparov's focused optimistically on where you have these uniquely brilliant moments for humans with machines. But, humans have some of these behavioral biases that we talked about many times, and over-exuberance is one of the specific ones. But it's interesting to think about how, a more optimized version, I think part of the problem is that the people managing the models at Zillow were not people in position they were not like what you'd call boots on the ground in the real estate industry with immense knowledge of what the buying and selling process was like and what you should be doing. They were people who were running a web platform designed to bring eyeballs in and to sell ads to real estate agents. So, they probably could have put the model in the hands of people who are more capable and adept at managing it, and perhaps they would have had a better outcome. Another company I think about where they really do leverage this idea of human plus machine equal better outcome, though there is some friction at the moment, is Stitch Fix. The entire premise of Stitch Fix is that you get a box of 5 items that you haven't seen. These items were selected by a stylist who was given algorithmically a array of selection of an assortment that you as a person as a customer should like. And so the stylists were given some discretion to use what makes humans uniquely powerful. So I want to list a few of the forces that I think where humans do best alongside machines. And these are borrowed from Kasparov, from a couple of my own observations and, reading about the topic generally. There's a great HBR article about it. So humans are unique for creativity, intuition, improvisation. I found the improvisation one funny because it's like, I love this idea that oftentimes your greatest strengths are also your greatest weaknesses, because, Kasparov himself, I'm not a chess player, so I can't say, I don't know enough about like which game or what exactly it was that threw him off. But he has talked about how there was one game where Deep Blue's opening move was so mind-blowing and head-scratching, and he had no clue what was going on, where he got lost in his own head, overthinking the magnitude and the meaning of it and what it might have identified about him. And that was, I think, the first game he had lost to the machine. So, improvisation, you throw someone off their game and he improvised the wrong way, though it is one of our great strengths. Those are traits like creativity, intuition, and improvisation. You can't program them. The other area that I think, humans are uniquely well-suited and powered, especially when you could kind of find context where it's important and you add that to a machine, is social and emotional intelligence. And, there are certain sides to it where we can't fight our own emotions, but we can recognize social context and we can recognize emotion in other people. So I think what I wanted to do is ask you guys 2 things. And I want to ask the audience at large. So I hope you all come at us with some of your answers to this as well. But so first, what are some areas where it's clear human plus machine works better than either or? And then second, can you think of any companies built around the idea of empowering humans with machines to be better than either in isolation? So I'm curious what you guys think.
I'll have to think about the second one. The first one, areas that are better where humans plus machine work together. I think that 2 of my favorite topics certainly fall in this category for sure, which is investing in sports. I think it's beyond reproach now that investing is better done with what I call a quantitative plus qualitative kind of framework. I personally would never want to remove the human judgment, the human element from all investment decisions. There are some things that just can't be quantified. But at the same time, if you're not quantifying as much as you possibly can and putting it in the proper context, you're missing out on a lot of things, and you're probably going to be swaying too much to the tune of emotions rather than data and facts such as they exist. So investing is an easy one. And likewise, sports. I think it's also goes without saying that over the last 20 years or so, you've seen a revolution in the way many sports are played. And that's largely because of this human plus machines kind of framework. And it goes back really to scouting, which is a lot like, particularly early stage, but really all forms of investing, right? When you're looking at a player and trying to make a decision about whether that player would be a good addition to draft or sign to the team, you're making all sorts of inferences, right? You have to draw on all sorts of data sources to predict the future and fill in the blanks for all the unknowns that there are. And a lot of human-only scouts reason by analogy in that world, right? I think it's just fascinating when you look at somebody like, I know they've fallen out of repute now, but what the Houston Rockets used to do, where they'd say, look, you're not allowed to make an analogy. You're not allowed to compare player A to player B because it's just such a lazy way of thinking. And if you're going to do it, you have to switch up, kind of the basic frameworks that people are going to immediately use in their analogies, like height and weight or race or whatever the case may be, because it just traps your brain into this very lazy frame of mind, and it's suboptimal. Whereas if you use a lot of data in your scouting and use that to set the base rate, it's just a much, much smarter way to do it. So, and that applies to all sorts of different games, not just, the team sports that we're all familiar with, but those are two obvious ones that jump out to me. And I think it's a fascinating topic. I certainly agree. I hadn't really thought about it in the context of Stitch Fix, but I guess the whole company was really founded on the Kasparov Principle, right? The premise that human plus machine is better than either one standalone. So that's an excellent point. I mean, as for the Zillow thing, it is fascinating. I agree. I haven't read that article that you referenced, Elliot, but it certainly seems to me that this has much more to do with humans programming a bad model rather than a model gone wrong or something like that. And that is, I guess, if I had to push back with anything here, that is often where I see this stuff get misapplied in finance. I think I've told the story before where one of the qualitative portfolio level models we used at my old firm back in the financial crisis really would have led us astray into taking a ton of risk in the summer of 2007. And then again in the summer of 2008, kind of a second bite at the apple that would have really ruined things if human judgment hadn't been able to come in as an override. So that's why I think there's an ampersand there, right? You have to have both sides of it. So
yeah, I think those are two great examples. John, how about you? What do you think?
Yeah, I have a few examples, but not really that many. But I think the question is really fascinating. I think what I'm kind of wondering about is whether this human plus machine is an interim solution that's better, or is this going to be the case forever? In other words, is AI ever going to get so powerful that humans can't add anything? And I think that's kind of the scary part for us is if we really cannot add anything. And so if you take chess as an example, and I don't know what's true today, if it's still true that human plus machine is better, or if chess has actually been solved, quote unquote, by machines where they can literally, computers are so powerful that they can see every move that's possible till the end of the chess game. So I don't know where we stand on that. I think the game Go is even more complex than chess. And I'm pretty sure in that one, it's still the case that human plus machine is superior. And it may well still be in chess, but I'm not sure. I think in terms of examples, I mean, one of the reasons you've seen costs go up at Facebook, well, one of the smaller reasons, I guess, is the human moderators they've had to hire to kind of weed out some of the worst content being posted on Facebook. I think that's an example of, machine plus human doing a better job than just machine. I think generally it's a tough business model. I mean, if it works, it can work well, but I feel like you're always in danger of someone coming along and doing the same thing without humans just as well. And if that happens, then you're left with a higher cost structure and kind of may get blown out of the water. The thing with what happened with Zillow, I think that was just a case of setting the wrong incentives and having the wrong goals. It's kind of like if you compensate your insurance underwriters based on market share, you're going to get a bunch of bad underwriting. So it sounds like that was mainly what went on there. I think other examples, I think an interesting one is some of the CAPTCHA systems out there, where basically humans, in filling in these CAPTCHAs, they were helping machines, I think, digitize old books or something along those lines. And then in terms of just thinking much farther ahead, what are humans uniquely well suited for? And Elliot, you talked about this. Empathy is the one that I always keep coming back to. I think it's going to be very hard for machines to have the empathy of humans, and maybe at some point that is the value that we're going to be adding in a world that's moving more and more toward AI and machine learning.
Yeah, those are just some great examples. Really good. And, I had actually written down next to Zillow, the problem was incentives, not humans or models. And I didn't say the word incentives, but that's one we keep coming back to. And that's so spot on. They were geared toward optimizing for the wrong thing, not what the human plus machine should have been trying to do. This notion of empathy as being uniquely human, I think it comes along with, social and emotional intelligence, and you could maybe just broaden the scope of that. But I like that you added the word empathy, because I think that is one where no matter how a machine with AI evolves, you ask the question, will AI get there eventually, being able to do some of these more human things? That doesn't strike me as likely, at least based on what we know about where it's going and what it's capable of doing. But it could probably mimic some degree of humanity and humanness to us. So that's, different than actually internalizing it. I am a little surprised more companies haven't been built around these principles in general. Like, I recognize the idea that perhaps you end up with a bloated cost structure, and whatever you could automate, you would. But, it makes sense that Stitch Fix is an area where human plus machine was the starting point. Stylistically speaking, you do need a degree of human connection. Taste is something that one would think is inherently human. Although I wonder if there are AI efforts at recipe generation built on scraping historical recipes and finding connections between certain flavors and building models for that. As I say, taste is inherently human. But also, Phil, I'm glad you said investing in sports, because, I had the topic once about the book MVP Machine. And I think that was one of the big lessons in sports, where they went too far empowering their models and realized there were gaps in being able to recognize skills where you could then layer on some of the lessons you have around optimizing individual performance, in a more automated way, and bring out the best in certain people. And I wonder if there are other areas, other industries that are involved with surfacing ideas where that sort of process and approach could be deployed. And investing, right on. I was I wasn't necessarily going to say that myself, but investing is one of those areas where there are some people who've deployed it really well. And I think there are increasingly interesting applications, though one of the hardest parts is sifting out noise and what to feed your model. So I think that's an inherently human endeavor within it.
Yeah, I agree, because John's question's interesting, right? I don't know. I certainly won't even try to answer the great question of whether or not we're going to give rise to true artificial intelligence with a capital I, in the sense that it could become all-knowing and function on its own and, kill us or take over the world from us or something like that. That's obviously a great question. I just don't have anything to add on that topic. As for it pertains in a narrower, more benign sense to this conversation, I don't think you'll ever get to a point where this is an interim step, just because of all the things you just mentioned. I mean, empathy is a great point, but I mean, take it back down even to a simpler level, right? I mean, incentives, like we all just said, it's really hard to model psychology. Humans are messy, they're unpredictable sometimes, they're emotional. It's very difficult. I mean, this is where the best models, whether it's LTCM or something else, the best models can't account for human behavior, particularly human behavior in crowds. And that's really what matters in a lot of businesses. And so I just don't think you're ever going to get away from that. And even more prosaically in the context of sports, let's say, if you're trying to design a team, you can certainly use human plus machine and rely on the machine to make far better decisions But I think we'd all agree, no matter how hard-nosed and analytical nerd you might be, that things like leadership and chemistry and personalities still matter. And if you assemble a team where you pay no attention to that, you're going to do a poorer job than you would be if you took that into consideration. So it just seems like there's no escaping the human element across any of those boundaries. But I am fascinated on a related note as to other companies that are going to be developed and run along these lines. I mean, I think Netflix has certainly been run partially along these lines for a long time. I mean, they ran that contest years ago to see who could develop the best recommendation algorithm. And to your point, Elliot, that is kind of like scraping for recipes or trying to define taste, because what movie you like is going to be different than what movie I like and what everybody else likes. And it's a very personal thing. So how do you get that algorithm tuned as close as you can possibly get? And that's a very difficult, very subjective exercise that's never going to achieve true perfection, right? To the point of John's question about getting to an all-knowing algorithm there. I don't think that's really possible, because, what movie I like may even change from day to day. How would an algorithm really, capture my mood or what I'm interested in watching at a given time? So it just doesn't seem like it's really possible. But I do think that curation of choices, as we've gone from an era of scarcity to an era of abundance, I mean, I think that's why something like Stitch Fix would have a place there, because it's just, there's too many choices out there, right? The paradox of choice is that if you have more than 2 or 3 or 4 choices to make, sometimes your brain just kind of melts down and doesn't know how to respond, and it certainly can't make a good decision or take action on it. So having a curation engine that can limit those choices and present them to you in a usable manner is a really, really valuable thing.
Yeah, I'll jump in real quick. Phil, I when you talked about algorithm, I was thinking of the YouTube algorithm and how scarily good it actually is. I mean, it kind of surfaces videos that I end up watching but would not have actually searched for myself. And an example going back to kind of the early days of the web, the Yahoo search engine, or better word, web directory, was kind of I think there was human input into the making of the Yahoo directory, and it kind of got blown out of the water by the concept of search and Google. And I'm pretty sure that Google really tries to have everything run by algorithms without human input. So it's a big question. I think as far as investing goes, I agree that human plus machine is the best and will probably stay that way. Although there are areas of investing that I think will go machine only, where it's super quantitative or kind of simplistic types of investing styles, or things that can be tested on a lot of data. But in investing, some of the biggest gains or losses occur at times when there are big swings in the market. Things change on a macro scale, and models are not good at predicting things for which there's not a lot of data. And so I think, or as you said, Phil, kind of human emotions, greed and fear. I mean, how are machines going to predict greed and fear? They're probably better at not being fearful, but at the end of the day, humans might jump in and override that.
Yeah, no, I think those are like interesting questions too, because when you look at what the models are designed to do, I think when we talk about something like YouTube in contrast to investing, with YouTube, what you're speaking about is like an optimization function where you're trying to find the perfect fit for a person. With investing, it's a competitive function, and it's more zero sum in its potential outcome. And you need humans to watch each for like different things. So like right now we're facing the question, is there like a morality behind YouTube's model that's inherently flawed? And there's no machine that could inevitably be the arbiter of that. And so you need to have people battle out, like, to what extent do you need to inject new thinking into or incorporate new flow of ideas, a new flow of content into the model, so you don't just very narrowly steer someone down a tunnel. And then investing, you have like these competitive playing fields where you could end up with, I love the Andrew Lowe paper on the quant meltdown, where all these models are effectively doing the same thing without realizing that they're competing with one another, and too much capital gets pulled in them and they make each other fail, right? Everyone fails together when they all felt that they were each winning individually. And so humans have to be sitting there at the dial trying to assess some of these questions, like, are these things happening in an optimizing function? Am I optimizing for the wrong thing? Has my optimization gone too far? Is it too narrow? Should I be injecting some degree, something that's new, some degree of newness to it? When I've done a lot of calls on Stitch Fix, one of the things people say that they do have some churn in their customer base from is that the model's designed to be more down the middle and capture like the mainstream of taste. But once you kind of fill your wardrobe with that, you're probably going to want to be filling the fringes, not the core. So, those are tough questions that you have to ask. For competitive ones, you do have to be very conscious of, like, when everyone's doing the Moneyball strategy and every player's 3 true outcome and you've given up on speed, have to ask this. So you need a human to ask the question, should I get a little speed in there to create some dynamism? I remember the Royals destroying my Mets in the World Series in 2015 because their speed just wreaked havoc on our ability to like function as a team. It changed the mentality of the entire game. I think you guys raised some really good points, and it got me thinking about this distinction between these two kinds of models. I feel like that should matter a lot.
Got to be some more good companies too. We'll have to circle back with some more examples we can think of.
And the audience, help us out. I'd love to hear some more. We got some good answers a couple of weeks ago when we asked for when we asked for companies that were doing very low cost of something much bigger. So hit us with your ideas.
Yeah, definitely. And Elliot, great point there on the distinction between competitive. I feel like it's also such a profound statement that you made, Elliot, on machines really having no values. And the YouTube algorithm will lead you down a rabbit hole. And but what values is it really, trying to imbue society with? And I think that's also part of this whole question around who gets to decide those values, because machines are just going to do whatever kind of optimizes for what they're given, which is time spent on YouTube, let's say. And who should decide on those values? Is it all of us, or is it just the shareholders of those companies? Is it just the management? I think those are all big questions that we're not going to resolve now, but I think as a society we're going to have to deal with those for a long time to come. Guys, thank you so much for another great discussion, and thanks everyone for listening. See you soon. Goodbye.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.